It does take us to our talk of the tape. What might the week ahead bring with Apple on deck, the Fed meeting in focus, and probably so much more? Let's ask Cameron Dawson, Chief Investment Officer for NewEdge Wealth, with me here at Post 9. It's good to see you. Welcome back. As I said, an ugly end to a pretty rough week. What do you make of it?
Yeah, it would have been nice to see a healthier bounce, mostly coming out of yesterday, where a lot of the indices got short-term oversold. We saw the RSI hit oversold levels. Some of the breadth measures looked a little bit washed out. So to see even more selling into that just suggests that there's more digestion to come. And the reality is that in the near term, we've been setting up this series of lower highs and lower lows, and that isn't showing any signs of turning yet.
Are you giving up on the idea that we could have a late year rally, or is it too soon to do that?
I think it is too soon to give up, but of course, the lower you start the rally, the less likely that you get back to the prior highs that we reached in July. You'd have a much more room to go. But the reality is that we've seen these bounces, and clearly after a day like today, we could see another bounce like we had in early October, but they've been rather tepid. So I think we're still in the mode of you have to judge the bounce as it comes.
So what do you make of what's happened in tech this week? I mean, it was the biggest question going in, along with where rates were. Big part of the thought was, okay, rates can remain a little bit elevated as long as mega cap comes through and delivers. Yeah. I find that we end the week not really feeling great about where mega cap is, and rates are still elevated. So where does that leave us?
Yet compared to the rest of the market, tech is holding up okay. On a day like today, we see that tech is almost back near its relative high versus the S&P, which is surprising given this rates backdrop. We think one of the reasons this is happening is people don't want to sell their tech because they're probably sitting on big gains this year. So you may be less likely to take gains into the end of the year, maybe waiting until 2024 to do that.
Although there is a view, and I mean, there's action, not just a view. I've talked to some investors, whether on halftime or elsewhere, who are buying the dip.
Yeah.
I mean, we've seen it. You know, Alphabet sells down hard. Stephanie Link, comes in and buys it. Steve Weiss, he's not real positive on the market, but he buys some of these mega caps too on the dip. Meta, Microsoft, and others are doing the same.
Yeah, they're great companies with actual earnings revisions going higher compared to the rest of the market where we're starting to see some earnings revisions turn lower. The biggest question going into 2024 is you have a name like Amazon, which has had earnings go up 350% this year. That slows to 30% next year. What does that second derivative slowdown mean for the performance of the stock? But at the end of the day, these are great companies. Valuations are far more reasonable today than they were back in July, which is likely why some people are saying it's a good time to step in.
A lot of the commentary over the last few weeks, utilities, a total disaster, staple stocks not doing anything. Obviously, we have a little sign of life now because the market is feeling a little upset. Is that just what it is, a moment, or is it something to build on, you think, for those areas?
We're still technically in downtrends on absolute and relative basis for utilities and staples. So we're seeing a bounce, but we still need to see evidence that there is a sustained turn in relative performance. If that happens, and if utilities and staples really start outperforming the market, that's a sign that growth fears could be coming back. And one of the questions we're asking ourselves is, are we at peak growth? Look at the GDP print from this week, 4.9%. Can it get any better than that? And is that maybe what utilities are sniffing out?
If I feel like I need to play a little defense, where do I do it? Bonds? I mean, is that the most obvious choice? They still super cheap relative to where stocks are?
If you really want to play defense, you're playing bonds within the shorter end of the curve because you still have the risk within bonds that yields could move higher on things outside of just the economic cycle. That supply and demand factor of what we're seeing within treasuries that is impacting the long end of the curve. TLT continues to struggle, and yet you still see big, huge inflows into long treasuries. So people are trying to catch this bottom. It hasn't worked yet. So if you're playing ultra defensive, that cash-like is likely the best place to do it. However, we would argue that there are a lot of stocks that are now trading at extremely attractive valuations. Look at the equal weight S&P 500, just 5% above its October 2022 lows. So you're already seeing that washout in valuations in large parts of the market that still really have good fundamentals, even if we see growth start to slow a little.